Shares for beginners. Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Warren Buffett, remember .com back in late 90s and sort of all fell apart in the early 2000s? People really turned against Warren Buffett then. I mean, he was getting some really bad press. Some of the headlines even in our own Australian Financial Review were pretty damning. You know, the guy's lost his touch, he's hopeless. Everyone was making money in .com. Buffett wouldn't touch the things. The reason Buffett did that, didn't change his plan, is he had a plan. He worked it out years ago. And he was not swayed from it. And he was ultimately proven right. So even though you can look like you're doing the wrong thing, if you've worked out a system or a method that works, stick to it, because you can be wrong for a while.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How do our brains process information, and what does this mean for our investing minds? Why are we wired to make constantly stupid mistakes? Joining me today to try and help us to simplify and rationalise our investing is Michael Kemp. G'day, Michael.
Hi there, Phil. Good to be with you.
Michael has written 3 investment books, Creating Wealth, Uncommon Sense, and The Ulysses Contract, How to Never Worry About the Share Market Again, all advocating for disciplined, long-term investing strategies. These days, he focuses on managing his personal investment portfolio, travelling and contributing to financial education through articles and podcasts, most notably with the Australian Shareholders Association. We met face-to-face, not virtually, for the first time at the 2025 annual conference, and this interview is based on Michael's presentation. And you're going to be making a presentation this year at the upcoming Gold Coast conference, aren't you, Michael?
That's right, Phil. Yeah, it's the theme is going to be about retirement.
Well, I'm very excited about that. Well, not about retirement, but about seeing you at the conference again. But I'm assuming we're not going to be listening to Led Zeppelin backwards this time?
Yes, that proves you were there. No, that was something I used uniquely for that presentation.
Yeah. So just a reminder as well, in the episode description and the blog post, you can avail yourself of a substantial discount, which is available for listeners of the podcast, not members of the association, by the way. Okay, let's jump straight in. Tell us about the difference between trying to be smart and trying not to be stupid when investing.
Yeah, that was the theme of my presentation. I just want to kick off by saying that what we're going to discuss today, Phil, is probably the most important issue, the most important skill that any investor needs to get right. And it's the way they think, the way they process information. And your first question is kicked off with that straight away. You'll remember in the presentation I talked about the great Charlie Munger. He was once asked at a dinner party what it was that made him such a great investor, and he simply replied with 2 words. He said, "I'm rational." The implication in that was that most investors aren't rational, so just getting things right delivered him an edge. I think this is reflected in how many different investment techniques there are out there, and there's a near endless list of the way people interact with the financial markets. Technical analysis, market timing, value investing, Dow theory, swing trading. I mean, the list is near endless. The thing that gets me is there are passionate adopters of these techniques, and equally there's as many opponents that say that they don't work. Each denies each other's technique and they argue about what works. They can't all be right. And I used to wonder why that was. It used to confuse me when I first entered interacted with the financial markets myself. And I went down through quite a few blind alleys, but the fog started to clear when I realised that the diversity of opinion was due principally to the way people form their beliefs, that people can passionately believe something without a lot of evidence. In other words, wrongly. And while definitive answers are often difficult to find in finance, proving something, people's faulty thinking is a huge issue here. It takes very little for people to start passionately believing in something. And while rational people look for evidence before they believe anything too strongly, most people just simply bypass that step. So this gets right to the core of how we need to behave as investors. Don't form ideas quickly. Don't form beliefs quickly. Because if you hold stupid ideas about investing, then you'll use investment tools that don't work and you'll lose money. So getting back to Charlie Munger, he used to tell us this. So in my presentation, I quoted him. He said, "It's remarkable how much long-term advantage people like us," and by us he meant he and Warren Buffett, who is his great pal, "have gotten by trying to be consistently not stupid instead of trying to be very intelligent." This all ties in with the well-worn Ben Graham quote that an investor's chief problem, even his worst enemy, is likely to be himself.
I know it's also, there seems to be this feeling that people have, is that in most areas of life you achieve by working very hard and just trying to keep the wheels turning as much as possible. But it's not the way with investing, isn't it? Sometimes you just want to be slow, don't you? And very deliberative.
And this is what I stressed in my most recent book. It's all about discipline. It's all about patience, and it's all about consistency. You know, people, a lot of investors, particularly young young investors, I should say, they're just spinning their wheels. They try this, they try that. They're impatient. They want to make big returns quickly, and that's not what investing is all about. It took me years to work that out. I was about 30 before I started investing sensibly. And I'm way past 30 now, I could tell you.
Just a day or two. That's just embarrassing, isn't it, when we think about, some of the mistakes that we've both made. You seem to be dismissive about behavioural finance, because this is a whole discipline we hear about as well. Behavioural finance is something that's really studied, and there's professors and academics who are just working on this. But you think the answers are in basic psychology, don't you?
Yeah, but I think they're linked. I mean, all we're doing when we're looking at behavioural finance is the outcome of what I'm talking about. It's sort of the superficial way that people behave. So it's not that I'm dismissive of behavioural finance. I just think a lot of the way it's described by, Kahneman and his mate Tversky, unfortunately died years ago, Mir Statman, Richard Thaler, these guys are professors of behavioural finance in the States. I just think a lot of it's too observational, and it doesn't get to the core of the problem. It's the outcome of the problem rather than understanding why it happens. I think it's a lot more powerful when you understand the reason or reasons behind why we behave irrational. If you understand why, then you can internalise it, realise that you yourself are prone to that behaviour, and then you're sort of more empowered to change your behaviour, to behave more rationally. I've always wanted to understand why. And if you understand why, you can act much more powerfully. And I talked about, a couple just then, Danny Kahneman and Amos Tversky. They talked about prospect theory. This is one example of behavioural finance. I'll give it, and an example helps explain what I'm talking about. They talked about prospect theory, where a financial loss is felt with greater emotional impact than a gain of the same size. I mean, we've all heard that. They developed the concept together in the late 70s, and Kahneman was later awarded the 2002 Nobel Prize in Economics for that work on prospect theory. I thought it was actually rather strange that he got a Nobel for that, because something that amuses me about that is I'm a reader of James Bond books by Ian Fleming, and his 1955 book, 1955, I mean, this is long before 2002 or the 1970s, his book Moonraker, Ian Fleming wrote about a night when James Bond was out and he'd made a big win at the gaming table. And Fleming speculated that the loser would be feeling more pain than James Bond would be feeling pleasure. I mean, it's prospect theory in 1955. And if you want to go back even further, Daniel Defoe, the author of Robinson Crusoe, the 18th century author, wrote about exactly the same thing 300 years ago amidst England's South Sea bubble. So I'm surprised that Kahneman got a Nobel Prize for that, but he's not here to defend himself anymore, unfortunately. Look, behavioural finance covers a near endless list of heuristics and biases that we have. It describes irrational behaviour, but I don't think reading about them helps people much, because they just look at them and they say, well, none of that describes me. I'm rational. That other people do that sort of stuff. The fact is, Phil, that none of us are truly rational. We just differ in how irrational we are.
And it's interesting, isn't it, that the fact that this kind of research has a Nobel Prize attached to it gives it another level as well, doesn't it? That it's a Nobel Prize. This must really be something worth following and worth thinking about, when in fact what you're actually saying is...
It's a relatively simple idea.
It's a relatively simple idea, isn't it?
Yes, it is. In fact, I think a lot of us have felt that. We really have. I mean, we've got a share that's climbing, and you sort of get excited about it first, and after a while, it's a bit of a yawn. But if a stock goes down by the same amount, you actually do feel a bit more pain. Anyway.
Yeah, and I think it was interesting, just thinking back to the last time we chatted as well, that you talked about dividends and the power of dividends, because we've got another guest coming on next week talking about dividends as being kind of a very good ballast to you psychologically. So it helps you to build resilience, just knowing that you're going to be getting that dividend payment into your account, every 6 months or so.
And it's a very important skill once you hit a certain age, certainly when you hit retirement, because, the capital movements of your stocks, either up or down, they seem to wash over you after a while, particularly when you've been through a few crashes. I was on the stock market floor in 87, and of course I went through, the global financial crisis and everything else that's happened since. After a while, it all becomes a bit of a yawn. The first time it hits maybe, but after a while you just go, well, the stocks keep paying dividends. So it was overpriced or underpriced, who cares?
Are you confused about how to invest? Life Sherpa can ease the burden of having to decide for yourself. Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Situation normal, as some people would say.
Yeah, the stock market's volatile. Who cares?
Okay, well, let's get back to our brains. And what's the effect of having a brain that's been developed to avoid becoming a wild animal's luncheon?
Yeah, look, I think it's really important when you think about behavioural finance, or how we think, or how rational or irrational we are, I should say. We need to place human existence in some sort of perspective. Scientists have traced our ancestry back to a small hominid that walked around Earth about 2.5 million years ago, and we've progressed from it. We've developed from it, eventually into Homo sapiens, which has been around for about 300 to 400,000 years. So our brain development can be traced back millions of years. It means that our brain developed in a very different world than we live in today. And we still think like that animal that used to walk around in the hostile environment. So about 99% of our brain development time has been in a hostile world, where our greatest threat wasn't cancer or heart attack or even our share portfolio collapsing, but from a violent attack, either by another tribe or a wild animal. The result is our brain is primed to come to rapid conclusions, not to seek evidence before we come to that conclusion. And the evolutionary hangover about all of that is that today we still develop strong beliefs very quickly and based on very little input. You can see that was very rational for our ancestors to behave that way, because it was life-saving. It didn't really matter if the threat wasn't real. At least they reacted when it was real. But it's not rational today to behave that way, particularly in financial markets. We shouldn't be coming to rapid conclusions and rapid decisions and form opinions very quickly. We do it subconsciously.
Do you find that there's a lot of market commentators who form decisions and talk about them very authoritatively?
They're as prone as we are, as anyone else is. I call them the Pied Piper. A lot of them are just as irrational as we are, but we listen to them. Well, I don't listen to them as much as I used to be quite honest.
And they talk about it with such seriousness. Authority. Yeah, I'm just trying to look for another word to say authority, because I seem to be saying authority a lot and authoritatively.
Phil, I think they're handpicked because no one wants someone, to be indecisive. I was asked a number of years ago if I'd, talk on TV about these things, about what happened on the market or what's going to happen in the economy. And I said no. And I think I did for a very good reason. If they'd asked me a question, I would have answered it so honestly. I might have said, I don't know. Well, who cares? I mean, the market didn't move much. It was only 0.5%. Doesn't mean anything. And I would have lasted one program. They would have said, the producer would have said, where'd they dig this guy up from? But the person who answers the question on TV always has an answer, always. And there isn't always an answer to deliver. So I don't really listen to them that much anymore. Anyway, we've got sidetracked again. The believing brain. The believing brain.
That's right.
Phil.
That's right. Yep, that's definitely what we're looking into today. And speaking of the believing brain, the Loch Ness Monster. Who believes in the Loch Ness Monster? Tell us about that in our belief systems.
Well, a lot of people believe in the Loch Ness Monster, don't they?
UFOs, all sorts of things.
Yeah, look, it's a fascinating study. And the reason I talked about that in my presentation is I went to Loch Ness. I went to Scotland last year, stayed at Inverness and went out to see the famous loch. And I found it fascinating. The highlight of my day was I got to meet a guy called Adrian Shine, who's arguably the world's leading expert on the Loch Ness Monster. For more than 50 years, he's devoted his life to investigating sightings of the Loch Ness Monster. He lives out there. And there's been plenty of sightings. For example, over the last century, there's been more than 1,000 sightings, which sounds hard to believe. And he's a skeptic. So I asked him, why has he devoted the greater part of his life to investigating something that I said to him, Adrian, let's face it, it's unlikely to even exist. And his answer, believe it or not, had a strong application to finance. And I found it fascinating. We had a great discussion. He found it also interesting because people's firm belief that the Loch Ness Monster existed didn't actually require any proof. So I thought, well, this sounds a lot like finance. Their belief was based on something that psychologists refer to as priming. If they came to the loch, even with the slightest expectation that the monster existed, then it was more likely they were going to see it because they were primed to see it. They'd interpret the shadow of a cloud on the water, a seal, and there are seals in the loch, a sturgeon, a floating log, wake of a boat, whatever it is, not for what they really were, but as the monster. None of the 1,000 reported sightings of the Loch Ness Monster have ever been confirmed as genuine, although there's people walking around swearing that they've seen it. Look, it's easy for anyone to fall prey to priming. This is where this whole thing
Led Zeppelin came in.
Yes, Stairway to Heaven backwards. I demonstrated in my presentation with that experiment. I see priming operating in the stock market. And a great example, I reckon, is charting. It's a bit like the Loch Ness Monster, because if you believe in charting and you're looking for things like flags and pennants and triangles and support levels amongst a bunch of squiggly lines, then there's no doubt you're going to find them. I'm going to get shot down for saying that, but I honestly believe it. I think people who believe in charting, there's a lot of things they perceive and see that just aren't there. And with that, there's the human phenomenon of patternicity. We look for sense in the world by looking for patterns, and we always have. You know, man on the moon, connecting the stars in the sky and seeing zodiac signs and reading palms and tea leaves. And I think patternicity is very much at play with charting. But getting back to priming, if you believe it, you see it. Not you believe it when you see it. It's the other way around. You're going to believe it. If you believe it first, then you find it.
So, Benedict Spinoza. Now, I'm a big fan of Bertrand Russell's History of Western Philosophy. And if you ever want to look up about these philosophers, because they teach us a lot.
The rationalists.
Yeah. So what does Benedict Spinoza, what does he have to tell us? What can we learn from him?
Benedict, some people call him Baruch. So, he carries a couple of names like John and Jack. He was a 17th century Dutch philosopher, and he was one of the three great rationalists in the age of Enlightenment, when people started to really think in a much clearer and more scientific way. The other two were Gottfried Leibniz and René Descartes, the Frenchman Descartes. These guys were instrumental.
René Descartes was a drunken fart, I believe.
No,
the mnemonic from Monty Python.
No. Look, these three guys were instrumental in developing the concept of clear and rational thinking and developed the scientific method that sort of pulled us into the age of enlightenment, and we started to discover a lot more about life and about the world. Spinoza recognised that people accept a statement as being true simply because they understand it. It doesn't matter if the statement is right or wrong. If it makes sense to them, then they'll accept it as a fact. And this is very dangerous. It's rife in finance, and it's another reason why there's such a diversity of beliefs. I think a great example in finance is economists who like to forecast. They're the masters of the causal theory. They'll tell you why something is going to happen, and they'll tell you through a narrative about how the future is going to unfold. Problem is, these prophecies so often don't, happen. But people are sitting in their lounge room watching the news program, and an economist comes on and they sit there and they go, wow, they believe it because the narrative makes sense to them. But the fact is, there is nothing factual about their forecasts or their narrative. Anything could happen, and anything does. So, look, we're wired. We're wired to do it. And this is why, getting back to Benedict Spinoza, he identified this hundreds of years ago. If you deliver a story or a narrative that sounds sensible, people will believe it. They won't bother looking for the facts.
No, that's right. That's right. And how do you believe these narratives form?
It gets back again to what I was talking about before, the way we've developed through time. Our ancestors long relied on the spoken word. It was the sole method of passing on information from person to person or generation to generation, and so it carries a lot of power. As I said, we've been around. Homo sapiens has been around for about 300,000 to 400,000 years. We don't know when the spoken word started because obviously there's no record of that. But we do know that the written word has been around for about 5,000 years. So there's absolutely no doubt for a long time, narratives were how we passed on information, how we communicated, how we learnt, how our children learnt from us. And that's why most people are more likely to trust a well-spun narrative than cold, dry research, which they're just not bothered to read. So if someone hears a narrative and it makes sense to them, they believe it. And when you believe something, why go looking for the research? It explains Spinoza's conjecture that a good story is enough to establish a strong belief, and there's no need to seek any evidence beyond that it's true.
So then you really believe that empirical evidence is really hard for people to wrap their heads around in terms of investing and many other things in their life, obviously.
Absolutely, because when our beliefs are established so quickly, so easily, and so, might I add, passionately, we don't feel the need to seek research unless we're aware of how to be rational. We need to understand that we're prone to fall prey to narratives. So we shouldn't trust our initial beliefs. We should go out and seek the research. And this happens in investing. Investors rapidly develop a belief in whatever it is, be it technical analysis or market timing or value investing. They believe it passionately. So they very quickly just dive in and want to use it. And this is what I was warning investors about, Phil. Don't trust what you believe until you actually look for evidence. And this is what Spinoza, Descartes were saying.
Yeah, for me personally, I think this has been one of the great things with the Australian Shareholders Association. And I know I go on about this quite a bit, but just to be able to go to one of their meetings where, there's a few dozen investors sitting around in a suburban hall and listening to them and hearing what they've got to say and challenging as well. To have your ideas challenged is so important because you want to break these narratives.
Thing is, Phil, often correct thinking is challenged because invariably you'll get someone in the audience who has a passionate belief that's wrong. And what they do is they use question time not to ask you a question, but to tell you you're wrong. And I learned from those times. Yeah. I enjoy it, actually, because it's exactly what we're talking about here. Yeah. They're the really tough nuts to crack, I can tell you, because they just don't want to believe you. They don't want to believe you.
Okay, economic forecasting. Let's dive deeper into that. Now, I know there's a quote, and it's something like economic forecasting exists to make astrological forecasts look good.
Yeah, I think Warren Buffett threw one out like that.
Yeah, I think Warren Buffett, J.K. Galbraith, I thought it was, but, there's...
No, Galbraith's quote was something like, there are two types of forecasters, those who don't know and those who don't realise that they don't know. That was Galbraith.
Yeah, I'd really highly recommend reading some Galbraith. He was a fantastic writer.
Yeah, John Kenneth Galbraith.
Yeah, he's completely forgotten these days, really, isn't he?
Yeah, no, I've read a few of his books. Anyway,
yes, that's right. We were talking about economic forecasting.
What's the role of, I forgot the question. What's the role of economic forecasting in investing? In investing, I don't think it has a role. I really don't, because the forecasts are so often wrong. People pay attention to, I find it fascinating that people do pay attention to forecasts. And I think they do because it makes them feel better. That, look, they don't know what's going to happen in the future. So they look to someone that can fill that void. And why not someone who is presented to them as an expert? It was the American economist and businessman Alfred Coles, who he lived in the last century, in the 20th century. And he said it well. People want to believe that someone really knows, and a world in which nobody really knows can be frightening. So it just makes us feel better. But after reading reams and reams of research about their capacity to forecast, and I've read several books on this and a lot of the research, I don't pay much attention to them. Phil Tetlock did a lot of work on this. He was an expert on experts, and he basically concluded that their ability to forecast was about the same as a bunch of chimpanzees throwing darts at dartboards. I have a saying that when an economist comes onto TV to deliver a prediction about what's going to happen in the markets or the economy, that the best thing to do is to use the time productively. And my advice is to just leave the room and go and make yourself a cup of tea.
Okay, so market commentators, as we've been saying, they do prime their audience. What are some of these techniques that you've seen for priming an audience, and how can we avoid that? Yeah,
getting back to this concept of priming, where if your senses have been primed, you're more likely to believe another input to your senses. Getting back to the Loch Ness Monster. I don't think they do it consciously or deliberately. I think they're just selected. It's just that some people are better suited to deliver forecasts and be on TV or be on radio than others. And they have certain characteristics. It's all about how they present to the audience. And this gets back to why I said before, if I was asked a question about why the market went up that day and there was no real reason, I'd say. So I would self-select myself out of being a forecaster on TV. I find that they shouldn't be too young, because we don't believe people that are fresh out of uni. They shouldn't be too old because I think, they're a bit doddery. They need to be articulate. They need to be well-dressed, wearing a suit. Tie helps. They talk the jargon. And most importantly, Phil, they need to be confident or unwavering in their opinion. People love people who are confident. Interestingly, Philip Tetlock in his research found that the really confident ones were more likely to be wrong. The fact that they're on TV or in the press or on the radio in the first place is a great primer for the audience, because it means that someone has selected them as an expert. So that's a primer as well. But look, just none of those things that I've mentioned bestow an ability to predict the future.
And I know it's amazing, isn't it, how confident they can be, but there's no mechanism for checking in the past for their predictions and what they were saying was going to happen in the future.
And that's right. They can get away with saying something. But the thing is, Philip Tetlock, who I mentioned before, the US professor who studies experts, did exactly that for years. He looked at their forecasts and saw how often they were right. So he did what most people don't bother to do.
Ditch the spreadsheets. ShareSite is Investopedia's top tracker for DIY investors. Invest smarter, not harder. Grab 4 months free on an annual premium plan at sharesite.com/shares for beginners. So how do you guard against these narratives? I mean, is it just the fact if someone's wearing a suit, immediately look at them with suspicion?
No, I don't think that. I don't think you should look at them with suspicion. But look, I think getting back to what we were talking about about Spinoza is don't trust a narrative in itself. You need to investigate the facts for yourself. So if someone tells you that, market timing, works, that's their belief, but investigate for yourself. Look up the research. Rather than just placing blind faith in superficial narratives, search for yourself. I mean, Descartes outlined this concept in his 1637 book. This is how long ago these guys are around. Discourse on the Method. And it's exactly what he talked about. He described the method of systematically disbelieving everything unless there is a well-founded belief or reason for believing it. Sir Francis Bacon, the great Englishman, he said the same thing pretty much 400 years ago. He said, doubt all before you believe anything. I don't believe a narrative is a well-founded reason for believing anything, unless it's maybe being delivered by someone that you know for sure is basing that narrative on a thorough understanding of the subject themselves. So you need to check that out as well. There's certain people you can trust as being right, but they need to deserve that trust. And I think now, and this leads back to a recent podcast you had about AI, and I found that podcast really interesting, by the way, Phil. It's never been easier than now to check for yourself the facts with the development of large language models like ChatGPT and Google Gemini. If someone says something and you want to check up on it, just look up on the ChatGPT and ask for a review of the research on that particular topic you're interested in. But I found this very important. When you do that search or that request, you need to add the qualifier peer-reviewed research. So you get the best quality research coming back at you. So, as I said, I don't think it's ever been easier to check this. I mean, Sir Francis Bacon and René Descartes and Baruch Spinoza, they couldn't ask ChatGPT. So, yeah, check the facts out for yourself is my answer to the
and also you've neglected Rod Stewart and reason to believe. We all need a reason to believe.
We do need a reason,
but we need good reasons to believe.
Yeah. I just look. The only song of his I know is Maggie May. That's an oldie. Yeah.
So we love a good doomsday cult on this podcast.
Oh, yeah.
What have you learned from doomsday cults?
Look, I think they're a great study for psychology because they typically hold really extreme beliefs that most other people think that are crazy. So it's a great study in psychology. And this gets to the crux of what I think is really important in finance, Phil. I don't think you should just read finance books. I think there's so much you can learn by diverse reading. I learned a lot by reading work from Michael Sherpa. He's a psychologist who looks at these things, looks at doomsday cults, etc., etc. Loch Ness Monster. How can you apply that to finance? You can. So doomsday cults, in my talk that I presented up for the ASA, I spoke about the US psychologist Leon Festinger, who co-wrote a book, When Prophecy Fails, very famous book back in the 1950s. And to research the book, Festinger joined a Chicago doomsday cult called the Seekers. And the cult leader was a woman called Dorothy Martin. And Dorothy Martin believed that an alien who was the current embodiment of Christ was communicating with her through automatic writing, where through her body, she wrote out messages that this alien was saying. And this alien, he had a name. His name was Sananda. He warned her that the world was going to be inundated by a flood on December the 21st, 1954. So she formed got all these cult members around her and got them to believe as well. But here's the good news for Dorothy and the cult members. Sananda was going to send out a flying saucer that would come and collect them from Dorothy's house at midnight before the flood hit. Guys, this does relate to finance, believe me. I'll get there eventually. So they're all sitting around in Dorothy's living room in the middle of the night, and surprise, surprise, the flying saucer didn't arrive. The press were there and people were watching, and, the cult members were expecting it, but the flying saucer didn't arrive. So Dorothy was in a bit of a bind. Rather than admit she was wrong, Dorothy manipulated the facts. She said after a few hours that Sananda was contacting her again, that there was a new message coming through on the line, and through automatic writing, the message from Sananda was that the flying saucer didn't come because the group sitting alone all night had spread so much light that God had saved the world from destruction. So Dorothy maintained her belief in the face of what we call disconfirming evidence. Now, what better, stronger disconfirming evidence could there be that the flying saucer didn't turn up? But Festinger found this fascinating. He coined the phrase that we've all heard of, cognitive dissonance. I know the story is crazy, but cognitive dissonance isn't crazy because we all do it. When things don't work out or they run against our belief, we change the facts. And I see it all the time in finance, Phil. We deny new facts if they run counter to an existing belief. I said this before. When I present to a big audience and I come up with something that I know is a fact or close to a fact, because as close as we can prove to be a fact, because I've read the research, someone will stand up and tell me I'm wrong. It's not question time, it's I'm right time and you're wrong time. If it challenges one of their beliefs, what they'll do is they won't ponder the new evidence and even think that they could possibly not have had it right. They'll react strongly to it in a knee-jerk reaction. And I find times like that fascinating because what they're demonstrating is cognitive dissonance. And we have to work hard against that. We have to keep an open mind. We have to look for disconfirming evidence, not deny it.
And this is really important for cutting your losses as well. I mean, you use the example of Magellan Financial Group that went through some problems, shall we say, over the last few years.
Lost a lot.
And it was all about cutting losses early when faced with mounting evidence against the initial investment thesis. And again, it was with a rock star fund manager as well, wasn't it?
Yes, it certainly was. Well, what you're saying is, I guess, if you own a share, if you own a stock or have a position and it's running against you, share price is falling, you've got to work against the tendency to come up with reasons why that's happening that are wrong, to maintain your position and say everything's going to turn out. We all do it. Investors do it. I've been guilty of it in the past as well. I hope I'm less guilty of it in the future. But look, when a position turns against you, when a share price starts falling, when you should change your view. Look, this is one of the hardest questions in investing to answer, when to get out. Yeah, because
so many people say, oh, well, this is the time to load up even stronger if you're, if you really believe in this company. Which might be the
right answer. It might be the right answer. Look, just because a position is running against you doesn't mean that your initial investment thesis is wrong. It might be, it might not be. But markets are fickle beasts. There can be periods when you're losing money, even though you're doing the right thing. And there can be periods when you're making money, even though you're doing the wrong thing. In the end, it's the long game that matters. So what do you do if your position is losing money? I haven't answered the question yet. Look, those who believe in stop-loss orders would say you just automatically sell when the share price has fallen to your stop-loss trigger. But confusing that issue, you read Ben Graham. He used to say that you don't sell a position simply because the share price has fallen, which is really conflicting to the new investor. Graham was a value investor. He was pragmatic. And he was of the view that you should only invest in a stock where you have a reasonable idea about what it's worth. So he would say that if a share price fell and it was an even deeper discount to its intrinsic value, then you should buy more. Exactly what you just said. But Graham would also be the first to add that if the facts have changed, you need to wipe the slate clean, get rid of your emotional baggage, and reevaluate the stock or the position with a fresh set of eyes. Difficult to do. A useful way to do that is to try and imagine, even though you own the stock, try and imagine that you don't own it. And you say to yourself, given what I know today, right now, would I buy it? And if the answer is no, then ask yourself why you're still holding it. So I would say the best plan or investment method to adopt is a well thought out plan that you've established well before the event and stick to it. And a falling share price can invoke a lot of emotion. So the worst time to be making decisions about the stock is when you're emotional. If you use stop losses, keep using them. If you're a buy and hold investor, remain one. And if you're a value investor, continue to keep that mindset. Remember, there's no such thing as the investor who's right all the time. Even Warren Buffett used to make some really, what he would call, dumb mistakes. Dexter Shoes is probably the biggest one he's ever made in his life, and he still talks about it. You just need to employ a consistent system that you know works in the long run. I'll give an example of that. Warren Buffett, remember .com back in late 90s, and sort of all fell apart in the early 2000s? People really turned against Warren Buffett then. I mean, he was getting some really bad press. Some of the headlines even in our own Australian Financial Review were pretty damning. You know, the guy's lost his touch, he's hopeless. Everyone was making money in .com. Buffett wouldn't touch the things. The reason Buffett did that, didn't change his plan, is he had a plan. He worked it out years ago. And he was not swayed from it. And he was ultimately proven right. So even though you can look like you're doing the wrong thing, if you've worked out a system or a method that works, stick to it, because you can be wrong for a while. So I know I haven't answered your question definitively, but boy,
no,
that was
okay,
a tough question. That was
sure
a tough question.
Yeah. You know, figures like Einstein, Darwin, Charlie Munger, they've always sought disconfirming evidence. Now, what about the mug punter retail investor just approaching the share market for the first time? How would you suggest that they look at themselves, at the market, at the companies that they're buying, to guard against the beliefs and narratives that we all form for ourselves?
Yeah, it's interesting, isn't it, Phil? I mean, you look at those three names. I mean, they were brilliant people, Albert Einstein and Charles Darwin and Charlie Munger. That they would continually question their own beliefs tells you something, doesn't it? If people that we hold in such high regard as great thinkers have challenged their own beliefs, then we as mug punters should be doing the same, at least. Look, you said to me earlier on that if people do that, they might be paralysed by disbelief. I don't think there's any need to be paralysed by doubt. If you're always doubting what you believe, I don't think that should be paralysing you. I'd flip it and say that seeking disconfirming evidence sets you free to continue learning. What Einstein and Darwin and Munger were doing was actively keeping an open mind. They saw that as a way to continue learning, testing what they already knew or believed, to progressively get closer to the truth, working to become more rational. By constantly challenging your own beliefs, your own investment beliefs about what works and what doesn't, you'll progressively develop into a better investor. Munger was 99 when he died. I mean, he didn't die that long ago, but he said he was still learning in his 90s, and he was seeking disconfirming evidence to the last, and he was a great investor.
Okay, well, let's wrap it all up into a nice package and bundle for listeners.
I think you need to be aware that it can be easily influenced through a process called priming, to believe things that simply aren't true. For example, don't accept someone as credible just because they are well-dressed or articulate or they appear confident or to know what they're talking about, because sometimes they're talking absolute rubbish. Don't passionately embrace an investment or trading technique without first seeking evidence that it works, because you could be losing money. Keep an open mind and don't continue to blindly defend an investment technique that you've adopted in the face of strong evidence that it doesn't work or only works in an expert's hands. And that's a risk. An expert might be telling you something, but doesn't mean you can do it. Chances are you aren't an expert. And to keep learning and to read widely. It's amazing how much information from other disciplines can contribute to making you a better investor.
Fantastic. Okay, well, looking forward to catching up again on the Gold Coast in September. And I'd like to add that in the episode notes and the description and blog post, you'll see links to a substantial discount if you'd like to come to the Gold Coast and attend. It'll be a great time there. Michael Kemp, thank you very much for joining me today.
Okay, see you, Phil, and thanks and goodbye to everyone else too.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.